Hey folks, this is Tom Nash, and today we got the CPI data, the Consumer Price Index, that's going to settle once and for all. Is this a good start of the year or a bad start of the year? This market has been nothing but confused for the past 14 days. 2 weeks of total chaos, confusion up and down. We just got 24 hours ago a great PPI data beating the expectations, and somehow the market flies out of the stratosphere and comes back to earth same day. So what the hell is going on? This CPI data is going to fix everything. It's going to clarify if things are good or bad. Well, guess again, because this CPI data is just as confused as the rest of this market of the past 2 weeks. If you look at the CPI data on the month-to-month, well, we're up 0.4%, which is higher than the expected number of 0.3%. Well, that means things are bad, right? Well, not exactly, because if you look at the core is up only 3.2%, which is better than the expected 3.3%. Well, that means we're better, right? Well, not exactly, because the year-over-year CPI is up 2.9%, which is 0.2 higher than November, but exactly as expected. But before you get too confused about this, relax. I'm going to break down everything. I'm going to explain how this impacts the market short-term, medium-term, long-term. What's the best strategy to navigate this volatile, confused market? Everything is coming up. Don't worry. Sit back. Don't click nothing. Don't smash nothing. Don't buy nothing. Just listen. So this CPI report was supposed to be the big kahuna, right? The PPI data is okay, the jobs data is okay, but the real deal, the real important measurement of inflation is CPI. And it was supposed to come in hotter or cooler and give markets some clarity about what the hell is going on. But as you just saw, there's different ways of looking at the CPI data. If you're positive, you have something to look at. If you're negative, you have something to look at, right? For those of you who are not statisticians or mathematicians, the mechanism is quite simple. We take a basket of goods and services, things we consume on a daily basis. We measure the price this month versus last month, and this month versus the same month last year, and we see how much prices have risen, right? If prices rise more than we expected, well, that means we have to pump the brakes on the economy because inflation is getting out of control. And if prices don't rise as fast as we expected, then we can actually hit the gas and actually accelerate the economy, let it run. That's the whole purpose here. Now, the ones who are in charge on accelerating or hitting the brakes is the Federal Reserve. They're the driver of the bus. And what they're seeing, the data, is supposed to get calculated by these complex algorithms, and the most smartest people ever supposed to make a decision on how they react, what kind of pedal they press, the brake or the gas, right? So in 2022, in March of 2022, these guys decided to hit the brake all the way. And they hit the brake so hard, we went up from 0 to 5.25% interest almost instantaneously. That was by July of 2023. And from that point on, we were in an elevated interest environment, basically in the brake mode, right? But in September of last year, just September, I know it seems like a long time ago, but in September last year, the Fed changed their policy and they said, well, inflation is doing fine. We can let go of the brake and we can start hitting the gas. And they started gently to hit the gas, lowering rates from 5.25 to 4.25. Right now, this is exactly what we are. We are in the midst or in the beginning of a cutting cycle by the Fed, most likely heading towards the 3% region, which is kind of the neutral rate, right? And the Fed has to decide how fast they want to get to that 3%. And maybe if things get out of hand, maybe they press the brake again, maybe they press the gas again. All depends on the CPI data. So when the CPI data comes in better than expected, we can expect more leeway from the Fed, more free money, good for the economy, good for the stock market. And when things come out hotter than expected, that means inflation is not under control, which means the Fed might slow down the cutting cycle, and it's going to be bad for the market and bad for shareholders. That's the whole purpose here, right? So how today's data, what we just saw, impacts the narrative of the Fed, right? The narrative of the Fed going forward, they have a whole year ahead of them, how this thing impacts, right? Are they slowing down? Are they accelerating? Well, the one thing I would just tell you is do not get carried away by one CPI reading of December of 2024. We're talking about one data point out of many, many, many data points ahead that may change everything. We're not back to the 1970s crazy interest rates, and we're also not, the job ain't done yet. It's just 1 month of inflation rising as expected. Nothing crazy. We're still below 3%. So there's nothing insane here. Right? So this result, I don't think changes anything in the way the Fed looks at this. And if you look at the way the Federal Reserve interest rate cycle is being priced by the market right now, and these percentages might change, by the way, because they're dynamic. Every day they might change. According to the Fed CME Watch tool, you'll see that the Fed has 6 months to make up their mind about the next cut. They don't have to do it right now and not in the next 6 months. Why? Because the current prices in the market, the elevated market we have right now, is pricing in there's not going to be a cut in January, March, and May. So according to this market, the cut is not coming anywhere before June of 2025. So the data points for December 2024, when the real cuts are going to start anywhere from June to December of 2025, really bears a minimal meaning on what the Fed is going to do. If you look at the other data points here, right, we have 9, 10, and 12, September, October, December, as the potential candidates for a Fed cut. Between 1 and 3 cuts in the last 3 months of the year are probably already priced into this market. But if you look at the middle months, if you look at 6 and 7, June and July, those are absolutely toss-ups. 50%, nobody knows what happens. These are the months that are going to drive the stock market up or down. We all know we're not getting a cut in the first 3 cycles. We all know we're probably getting 1 to 3 cuts in the last 3 cycles of the year, from September onwards. But right now, nobody knows about June and July, which means that if the data comes in ahead of June as positive, allows the Fed to cut rates faster than expected, a June or July cut, that's going to send stock prices up. But on the other hand, the opposite can happen. All of a sudden, we might have bad data. And then if we have bad data before June and July, and now we don't have a toss-up anymore, and we have maybe a rate increase, well, in that case, the stock market might plummet. The whole point here is about what happens before June and July. But as it currently stands, the current setup has a lot of time to develop. The Fed has 6 months to make up their decision, and none of what just happened today really bears a lot of meaning on that decision. The more important months are going to be what happens in March and what happens in May ahead of the June toss-up. That's going to decide where stocks are headed. And that concept should drive your strategy going forward. A lot of you have asked me over the past few days, well, Tom, the market has been red, it's been green, it's been confused. What are you doing right now? What is your strategy for 2025? And I'll tell you because I have it right here, ready just for you in my notebook. So my strategy starts with the mindset. I first of all take into consideration to whatever happens in the short term is absolutely normal knee-jerk reaction. The first couple of weeks have been confusing, but that's just the markets. The markets in the short term tend to overreact, and I'm not making any investing decisions based on said overreactions. I don't focus on the first 2 weeks of the year, not on the first month of the year. I look at what this year is going to look like based on geopolitics, on the economy, on macro data, everything that has to do with the next year, 2 years, not specifically how the market overreacted over the past 2 weeks. That thing is irrelevant. Now, the other thing is that I expect volatility to continue. I don't think that what we've seen over the past 2 weeks, as painful as it felt for some shareholders of certain stocks, Palantir, in general, if you look at the market, that's like a 3% drop. A 3% drop is nothing. It's a fart in the wind. Now, the market drops 5%, which is almost double than what we had in the first couple of weeks, 3 times per year. So there's still 3 times of what we just saw, times 2, and that is even before we talked about the 10% drop that happens every year in the market. So there's still bumps ahead. There's still volatility ahead. What we've seen in the first 2 weeks, it's not that bad. It's just a bumper, right? But because people have gotten accustomed to what we've seen over the past 2 years and they've gotten used to this complacency and the market just green every single day, all of a sudden that feels horrible. It's not horrible. The horrible stuff, the volatility is still ahead. You haven't seen it yet. And if you look at what happens in this market, you have to look at the macroeconomic data and the fundamentals in tandem, right? We'll look at this setup for 2025, and you have to look for reasons to be bearish about the market, right? So if the job numbers are getting better, if the economy is getting better, if unemployment is coming down, inflation is below 30%, it doesn't seem to be getting out of control, right? And if we have good GDP numbers, and we have a friendly administration to the economy and to M&A activity and to deregulation. And on top of it, we have cheap oil. We're in the winter, which means we're 6 months away from the peak of the cyclical oil prices. And we know that the relationship between Trump and Saudis could not be better. quite opposite of what this administration had with the Saudis. So we know the Saudis and Trump are going to work out some deal to keep oil prices low. And we're already in the mid-cutting cycle of the Fed, which still goes to 3%. So all of that combined with the fact that, yes, we did 60% in 2 years, but you have to understand the AI revolution just started. When Netscape came out, NASDAQ did 140% in about 3 years. Right now, we've done about 60% in year and a half? We're still midway through the bull cycle that we've seen in Netscape. Netscape did 140 in 3 years. We're about 60 in 2 years. So there's still room to run, as crazy as it sounds. And I don't think the AI revolution is any smaller than the invention of the internet. I think it's just, at least it's equivalent, right? Although, statistics and history mean nothing. But based on all these factors I'm looking at, I'm not seeing anything that might send the stock market down in 2025 fundamentally. Long term, the markets don't just drop because something has to happen to break the system, right? And right now, we don't have that. We don't have that in our eyesight, but it doesn't mean it's not there. There's a lot of unknown unknowns. COVID was unknown. We couldn't see that coming. Geopolitics can shuffle the cards and reset the whole game. Obviously, you have to take that into consideration. So you have to be ready for all scenarios, right? Even though you're bullish on this market, maybe like me, or you're bearish, you have to be ready for the opposite of what you're expecting to happen. And that means you have to do a few things. Number one, keep some money on the sideline, right? Keep some money on the sideline regardless if it's getting better or worse. You have to keep your balance. In the great market, everybody wants to own NVIDIA and Palantir and Tesla, but they forget that the S&P 500 is undefeated. No matter how good or bad things are getting, the S&P 500 is your safe haven for long term, right? You have to have a plan, right? I don't think that people who try to time this market, a lot of technicians out there, technical analysis and all this stuff, they have charts, they have numbers, they have their intuition, and sometimes they get it right. But I don't think timing the market is the way to do it. I think what we do here is we go with the punches. If we are in the boxing match, right, we do this. I'm not a boxer, but you get the point. The point is, I know in my head what I'm going to do if the punch comes from the left or from the right. I don't have to think about it in the moment it happens. I practiced this. I did it 1,000 times in practice. So when I'm in the ring, I know exactly what to do. Same thing in the stock market. So if you understand this, you understand that you have to have a plan. And the plan is very simple. You work out your DCA strategy, which stocks you want to invest in, how much do you want to invest every single month, every single week, and at which price point, at which threshold point do you want to double down? Basically, at which price do you want to buy more of it on a continuous basis? If you do that, if you selected better companies than the others, if you held for longer, and if you saved more money to invest more in the stock market, you're going to outperform your peers. It's very, very simple. The key here is not to try to get it quick. Warren Buffett once said, everybody wants to get rich. Nobody's willing to get rich slow. Getting rich slow is not that hard if you do these steps. And the one thing I'll just tell you is that don't look where everybody else is looking. Look for the things that people are ignoring. If everybody right now is hyped up about certain companies, maybe look for others that have a little bit less shine right now, even though they have great fundamentals. In fact, I'm going to let you in on a little secret. I have a top stocks list for my academy in my Patreon, patreon.com/TomNash. And on that list, I've just added a stock, which I think is absolutely ignored by the stock market despite having great fundamentals and a very interesting opportunity to not buy the hype. If you want access to it, go to patreon.com/TomNash, join the academy. We have, on top of it, 40 lectures that you can watch and 4 new lectures every week live, which you can watch, attend, and then rewatch again. All that is available in the academy. Would love to see you there. I'll see you next time. Don't freak out. Stay steady. Bye.